Hi friends, welcome to Amazon World. In this video, I'll be explaining illustration number 7 of admission of a partner and illustration number 19 of retirement of a partner. So I came with the decision of explaining illustration number 7 first because only if I explain you illustration number 7, you get to understand illustration number 19. If I get since I am not able to put admission of a partner portion completely, you won't be able to connect illustration number 19. Okay, so that's why I'm explaining illustration number 7 first and then going to illustration number 19. So before explaining illustration number 7, we have something to discuss, that is regarding adjustment of a capital. When a new partner is admitted, the total amount of capital is determined on the basis of new partner's capital. Okay, when a new partner is admitted, what are they saying? It is in the basis of new partner's capital that we are determining the amount of capital. Okay, if we read this like this, we won't be able to understand, but in illustration number 7, everything which is said here is going to apply in our question. Okay, so now let's see. On the basis of new partner's capital and his profit sharing ratio. Okay, so in the new profit sharing ratio and also in his also in the new partner's profit sharing ratio as well as on the new partner's capital, what are we going to do? We are going to determine the total amount of capital on the basis of new profit sharing ratio. Old partner's capital is to be ascertained. So this is the important sentence here. On the basis of new profit, what are we going to do? We are going to find the old partner's capital. Okay, so thereafter existing capital. See here, inside the bracket I have said something. After considering all adjustment. That is, at first we have to prepare our capital account. That is, we have to write all adjustment except for 1 or 2 adjustments which we can only write after finding the capital account. Okay, you will get to understand what I am saying right now when the question comes. Okay, so no worries if you are not able to understand me now. Now let's read further. Okay, so the existing capital after considering all adjustment is to be compared with the capital so ascertained on the basis of new profit sharing ratio. So that is what we are actually saying is there. When we prepare capital account, it is usually at the end we get balance carried down as balancing figure, right? But in this type of questions, what are we going to do is we have to find closing balance, that is balance carried down in a separate working note, and then we have to write it down in the capital account. That means the balances which we have to write in the new balance sheet is actually worked out separately. We won't get the balances as balancing figure. We have to find something else as balancing figure. We won't get these balances, capital balances, as balancing figure. But till the question which we have done here, we got balancing figures, right? Balancing figures were balance carried out in almost every question of addition of a partner. Okay, and excess of A needs to be withdrawn by the partner concerned and deficit of A needs to be brought by the concerned partner. So once we compare these capital, what happens if there is any deficit of amount? What have to do? The partners have to bring amount to the partnership firm, and if the amount is excess, then their partner can withdraw the excess amount. Okay, sometimes the excess or deficit is to be adjusted against the current account of the partners. So only sometimes it will be said in the question what we have to do with it. Okay, so now let's read illustration number 7. In illustration number 7, there are two partners, there are A and B. And their profit sharing ratio is 4:1. They have given us the balance sheet as on 31st March 2030. What is happening here? Now let's see. C is going to be the new partner. Okay, so C is the one who is going to be the new partner and is coming on 1st April 2030. Okay, so there are some terms. Okay, so these are the terms that actually make the question a bit confused. Now let's read. First point is A, B, C will share profit and losses in the ratio of 5:3:2. So this is the new profit sharing ratio. So they have given us old profit sharing ratio and new profit sharing ratio. What are we used to do with these two? We have to find the sacrificing ratio. So now let's find sacrificing ratio directly. So it is over, right? So let's see how sacrificing ratio is being calculated. As you can see here, A's old share is 4/5 and B's old share is 1/5. You have to subtract new profit sharing ratio from the old one in order to get sacrificing ratio. So when we did it, we got 3/10. That is when we subtracted 5/10, which is the new profit sharing ratio of A from the old profit sharing ratio of A. We got what? We got 3/10. Okay, we have to make the denominator same, and then we'll get what? 3/10. Fine. So 3/10 we got a positive amount, a positive answer. So that is a sacrifice. Fine. When it comes to B, what happens? When we subtract new profit sharing ratio from the old profit sharing ratio, we get negative amount. Negative 1/10 is what we get. So what does this negative means? That is, if we are going to do, wait a minute, Okay, see here, if you are going to do old profit minus new profit, so we all know this is the formula of finding sacrificing ratio, right? Sacrificing ratio, we used to find it by doing like this. So if you are getting positive amount, that means it is a sacrifice, but if you are getting a negative amount, what does it mean? It means it is gain. It is gain for that partner. There is no sacrifice. This partner, for example, in this instance, in this case, what is happening is B got negative 1/10. They are not showing negative here, that's why they have returned, instead of negative they have written gain here instead. Okay, so what does this negative means? Negative means B have not sacrificed. We all know when a new partner is admitted, the old partners actually sacrifice. So this portion I have covered in the first video of admission of a partner. That is also done in English. Okay, that is the only video I have done in admission of a partner in English. So please go and watch it. Okay, in order to understand this concept. So we all know the old partners or the existing partners would sacrifice for the arrival of the new partner. So once we look at sacrificing ratio, what happens? A is sacrificing. Okay, fine, but B is not sacrificing. B is not sacrificing, and C is the new partner, fine. So his share is 2/10, there is no change in it. So that's it. So what is the concept here is, since B is not sacrificing anything, it is only A that is sacrificing in the arrival of C. So what happens is that even B have to bring some portion of goodwill. So this is the concept. If B, like for example, existing partners have to sacrifice for the arrival of the new partner, we all know that, but in this question only A have sacrificed. B is also an existing partner, but he didn't sacrifice. So what does it mean? B have to bring some portion of goodwill along with C. We all know C, the new partner, would bring some goodwill to the firm, right? Likewise, B also have to bring some amount to goodwill. That we'll discuss later. So this is the first point. We have already found the sacrificing ratio, then that is over. Okay, now let's do the second point. C will bring rupees 20,000 as premium for goodwill and rupees 30,000 as capital. So this is the goodwill premium, this is the capital. Okay, then comes what? Half of the reserve is to be withdrawn by the partners. Usually what we used to do, here reserve is there, right? 20,000. Usually we used to divide this in a capital account, the credit side of the capital account, we used to share this reserve with the partners, right? Okay, fine. After that, what are they telling? They are telling that the partners are withdrawing the reserve, half of the reserve. For example, half is 10,000, right? So 10,000 will be taken, that is 10,000 will be withdrawn by the partner. Fine. So this 20,000 have to be shared among whom? The existing partners, because this is the balance sheet which was drawn when A and B was only there. C came on the next financial year. This is of the financial year 31st March 2013, that is 12-13 year. Here in 13-14 year only the C is coming. Okay, so this profit, the profit till this date will be shared among A and B. So the reserves and everything, if it is loss or if it is profit or any reserves, have to be shared among A and B only. So this 20,000 have to be shared among A and B, and what is happening? What is happening? The half of them will be taken away or will be withdrawn by the partner. Okay, then what's happening? The asset will be revalued as follows. So these things have to be written in our revaluation account. You all know that. Then comes what? A creditor of rupees 12,000 has agreed to forego his claim by rupees 2,000. Here is what sometimes some of you might get confused here. See here, creditors is of rupees 25,000, fine. In that 25,000, 12,000 is also included. Okay, 12,000 is also included in this 25,000, fine. So there will be lots of creditors, right? So they might have written the net amount of creditors here, 25,000. There will be lots of creditors for us. There will be lots of creditors. Let's say, for example, let's say there are 5 creditors. Okay, so one among that is all creditors together, we have 25,000 to give creditors. We will say we have the partnership firm have 25,000 rupees to give to the creditors. Okay, total amount. There will be lots of creditors, right? So one among the creditor, the partnership firm have to give 12,000. To one among the creditors in this. Okay, so this 12,000 is also included in this 25,000, fine. So what is they are saying? That creditor have agreed to forego his claim by rupees 2,000. So he's saying, okay, fine, there is no need to give me rupees 2,000. I'm just getting off the 2,000. Please give me the rest. That's what he's telling. But still in this question, they have not telling that the partnership firm is paying him rupees 10,000. That is not our concern. They have only told that what the creditor has foregone rupees 2,000. That is, the creditor have said the partnership firm, there is no need to give me rupees 2,000. Fine, I can just less this 2,000 from the 12,000 and give me the rest. That is what he's telling. Only that portion is given as. There is no sentence saying that the partnership firm has paid this creditor. Okay, so only what we should do, we can only subtract this 2,000 from this 25,000. We can only subtract this 2,000 from 25,000. We cannot say this. We cannot say this settlement is settled. It is not said anywhere that this settlement, this amount has not been paid by the partnership firm. Okay, it is not said anywhere in this question that this amount is being settled. Okay, so what we have to do here, we can only subtract this 2,000 from this 25,000. We can write the balance amount, that is 23,000 on the new balance sheet. So this we have to write in revaluation account actually. So these 2 points will be included in revaluation account. Then comes what? After making the above adjustments, the capital accounts of A and B should be adjusted on the basis of C capital. So this is the point, a very important point in this question. That is, after making the above adjustments, after making all the adjustments, what we have to do? We have to actually prepare the capital account. We have to do all these adjustments, and we'll get a total. Usually we get a total, and after getting the total and after finding the necessary items, only we have to find what? We have to adjust the basis of, on this basis of C's capital, we have to adjust A's and B's capital accounts. You won't understand me what if I'm going to just speak like this. You will only understand if I start doing the calculations. Okay, so no worries if you're not able to understand me right now. By bringing cash or withdrawing cash, as the case may be. So they are telling this question that you have to bring cash or have to withdraw cash in order to adjust their that is A's and B's capital accounts on the basis of C's capital. C's capital means, for example, is bringing rupees 30,000. Okay, so okay, we'll do the calculations later. Fine. This is the question. Now what we have to do? We have already found the sacrificing ratio. Okay, fine. Then second thing we have to prepare is revaluation account. We can prepare revaluation account. There is no problem in it. So let's just prepare revaluation account with this information. Okay, furniture is being revalued at rupees 30,000. In our old balance sheet, it was rupees 20,000. So 10,000 appreciated, right? So we are going to write it in the credit side of the revaluation account. By furniture account, rupees 10,000. Then comes what? Stock. Stock is of rupees 40,000 in the old balance sheet, and it is revalued at 39,500. So 500 rupees, right? So 500 rupees is reduced. So we have to write that 500 rupees here on the debit side to stock account 500. Then comes what? In the debtors, they are saying that it was 30,000, but now it is revalued at 28,500. So what we have to do? How is this debtors decreasing? Two options are there. Sometimes the debtors may pay off their sometimes the debtors may settle their accounts. That is, they might repay the partnership firm, so the debtors would decrease. Okay, fine. Then what is another possibility? This possibility is what we used to do. Which one? The provision for bad debts. We'll just assume that this 30,000 became 28,500 only because of provision for bad debts. So we are saying that it is provision for bad debts that making these debtors reducing. That is the assumption we have to take in this entire chapter. If it is not told in the question that provision, if nothing is being specified about the provision, and but still the debtors value is decreasing, we have to assume that it is because of the provision of the bad debts. So that is what same thing we are doing here. We are saying that this difference of 1,500 is due to provision for bad debts. So provision for bad debts is actually a liability. So we will what will be the entry? Revaluation account debit to provision for bad debts account, because provision for bad debts is actually a liability. So liability should be credited. So that we have done here. We are writing it here. The entry will be revaluation account debit to provision for bad debts. So when we write it in the ledger, where it will appear in the debit side. To provision for bad debts account 1,500. That's it. Then what else? And this creditor thing, right? The creditors. That is, in this 25,000 we have to subtract this 2,000. That's what they are saying. Okay, this 25,000 we have to subtract this 2,000, and the rest of the amount we have to write in the balance sheet. You can see here, right? Yeah, 23,000. We'll come to that later. Okay, so we are writing what? That 2,000 here, because creditors is reducing, so we have to write in here. Fine. So when creditors are reduced, what will be the journal entry? Creditors account debit to revaluation account. Okay, so that's why we wrote it in here. By creditors account, it will appear on the credit side of the revaluation account, that is rupees 2,000. Fine. And after totaling both the sides, you'll see that credit side is the greater side with a more total. So 12,000 we have to write it down here, and we'll get balance and we'll get the balancing figure as 10,000. Okay, so this 10,000 have to be shared among the existing partners. Okay, so in which ratio? It should be shared among the existing partners in their whole profit sharing ratio, which is 4:1. Understood? So that is how we prepare evaluation account. Fine. Now we are coming to capital account. So capital account is a bit dangerous. So I will prepare a different capital account. I will draw the capital account and I'll show you. Okay. So the very first thing we used to write in a capital account is the balance, right? The opening balances. That is balance. Brought down. We have to write here. We have to write by balance brought down. Okay, I forgot to write. It's been long since I last prepared a capital account. Okay, so by balance brought down, the balances of A is 25,000, B is 65,000. So we're writing it down here. Then in the adjustments of the question, it is told that C is bringing rupees 30,000 as a capital. So let's write 30,000 here. Okay. Then comes what? We have to share the revaluation profit, that is 8,000 and 2,000. So just write by revaluation profit, and you have to share that, show this here, 8,000 and 2,000. Okay, fine. Then in the old balance sheet they have given us reserve. So usually we used to share this reserve with the partners, that the existing partners. So 20,000 have to be shared among the partners in their old ratio. So when 20,000 is being multiplied by 4 by 5, we'll get to how much? 16,000, and here will be 4,000. Okay. Then it is said in the question that reserve, half of the reserve is being withdrawn by the partner. So we have to show that in the debit side to bank account. 60,000, half of 60,000 is 8,000. Half of 4,000 is 2,000. So when we total these together, we'll get 10,000, which is half of 20,000. Fine. The next thing we have to write is goodwill. Goodwill which is bought by the new partner. It is given in the adjustment, that is premium is of rupees 20,000. It will be given to whom only? A only. Why? Why it is only given to A? Okay, so I have told you that only A have done the sacrifice. In this case, in this question, only A have borne the sacrifice. B have got gain only. He have not sacrificed anything. So that means the goodwill which is bought by C can only be shared with A only. So we are writing the entire 20,000 under A's head. That is, C is giving that goodwill premium to A. That is how we are showing it. That is how we are showing it in here. And while we are calculating sacrifice ratio, I have told you that since B is not bearing any risk, that is B is not sacrificing anything, we also have to bring a portion of goodwill. So we have not calculated what is the portion of goodwill that we have to bring. So now we are going to calculate it, and now we have to calculate B's share of goodwill that he is going to bring for A, because since I'm telling you again, B is not has not sacrificed anything when C came. C is the new partner, so A alone sacrificed everything, so he is getting the goodwill portion of both C and P. So I have told you that since we have not sacrificed anything, E also have to bring goodwill premium and you have to give that to A. Okay, so that's what we have. So what we have to do, we have to find that amount which B is going to give A, that is a goodwill premium. Okay, so it is said here, entire goodwill to be credited to A's capital account. That is, whatever goodwill amount which C is bringing, that have to be only credited to A's capital account, since A is the only one who sacrificed. Now B will have to pay A for goodwill. Now B have to bring a portion of goodwill also. Okay, or we can say we have to pay A for goodwill. Okay, so that is what they are saying here. Okay, so the first thing we are going to calculate is the goodwill of the firm. So how do we find goodwill of the firm? There is no goodwill which is, there is no specification of goodwill in the question. So how are we going to find it? So since in this question they have given us the share of C's goodwill, that is rupees 20,000 they have given. So how might have they have calculated this 20,000? Let's see. C's share is how much? C's share is 5:2. What is the profit sharing ratio? New profit sharing ratio 5:3:2, right? So in here 2 by 10 is the portion of C, and we all know that 20,000 is the rupees, 20,000 is the portion of goodwill that C is to bring. So we are going to calculate the firm's goodwill. We have to first find the firm's goodwill. So in order to do that, see here, see the calculation. How did this 20,000 came? They might have multiplied the portion of C from the firm's goodwill. So once we apply this new partner's share in the firm's goodwill, we'll get the portion which the new partner have to bring. Okay, that is, once again, we all know the profit sharing ratio of the new partner. In this case, 2 by 10 is the new profit sharing ratio. So that is the profit sharing ratio of the new partner. Fine. So once we apply this profit sharing ratio on the firm's goodwill, only then we'll get the portion of goodwill which the new partner have to bring. In this case, they have given us 20,000 and they have also given us 2 by 10. That is the profit sharing ratio. But here now we have to do the reverse, because we have to find firm's goodwill first. I will tell you later why we are finding firm's goodwill. Only after the cases like this, I've told you, once we apply the profit sharing ratio on the firm's goodwill, we'll get the portion which the partner have to bring the goodwill. Okay, so that is the thing we are going to do. First, we have to find what is the amount of firm's goodwill. After finding the firm's goodwill, we'll apply the profit sharing ratios again in order to find B's goodwill. I told you that B also have to bring a share of goodwill since he didn't done any sacrifice. So we have to find the B's share of goodwill. So in order to do that, first we have to find the firm's goodwill. So in order to find firm's goodwill, what we have to do? We have to apply this. What we are going to do? We are going to do the reverse calculations. That is, firm's goodwill into new partner's profit sharing ratio will get the new partner's goodwill premium. right? So what we are going to do, we are going to do the reverse in order to get the firm's goodwill. So for that, we know that firm's goodwill into new partner's profit sharing ratio is equal to new partner's portion of goodwill. So we all know 20,000 is the new partner's goodwill portion, and 2 by 10 is his profit sharing ratio. So what we are going to do, 20,000 into 10 by 2. We are just taking this 2 by 2 from here, and once we go to the other side of the equal to, what happens, the multiplication becomes division, and division becomes what, multiplication. So here 10 is divided, right? So 10 have to be multiplied, 20k into 10 divided by 2. 2 was multiplied here, so 2 by 2. So that is how this is happening. So 20,000 into 2 by 10 is 20,000 into 10 by 2 is what we have to do. 20,000 into 10 by 2. This is nothing, it's just that I wrote 2 by 10 inside the bracket. Okay, see here, 20,000 to 10 by 2. So we got 1 lakh. We are assuming that this 1 lakh is the goodwill of the firm. Now we have to find B's portion of goodwill, since we told that B is not doing any sacrifice. Now we have to calculate. We got the goodwill of the firm. Now we have to apply a certain share on this. So what is that share? Shall we apply the new profit sharing ratio of B? No. Shall we apply the old profit sharing ratio of B? No. So what we have to prepare? What we have to apply on that 1 lakh? We have to apply the gain portion. See here, that is 3 by 10 is a sacrifice of A, and B have no sacrifice. That is, we go negative 1 by 10. Okay, don't consider the negative, take that 1 by 10. Okay, so it will be on this basis that we have to bring. Since we have not borne any sacrifice, what we have to do, we have to take that gain portion that he had, and we have to apply it on the 1 lakh, and he have to bring that portion as goodwill, since he have not borne any sacrifice. So 1 lakh into 1 by 10, 10,000 we got. So this will be the amount of goodwill that we will be bringing. So what we have to do, we have to write this 10,000 under A's capital account. We have to credit this 10,000 to A's capital account. Now what we have to do, we also have to debit that on the B's capital account. Let's see how it is done. Okay, so what we have to do here, we have to write how journal entry come. B's capital account debit to A's capital account. So under A's capital, what we have to write? We have to write by B's capital account. We'll write 10,000 here. Blank, blank. Okay. Please put a blank on wherever we don't have an amount. Okay, that will make it easier. Now what we have to do here? We have to write to A's account, capital account, and we have to write that amount where? Under B's capital account, that is rupees 10,000. Okay, fine. So this is how we do this. I hope this is understandable. Okay, now let's see how much adjustment did we finished here. We have calculated the sacrifice ratio fine, and we have give the premium 20,000. We have shown it already in the partners, and we have also withdrawn the half of the reserve fine, and we have already prepared the revaluation account. This one is also included in the revaluation account. And okay, finally here, so this point is what we have to focus. So in order to find this, in order to do this point, we have to do something else. There is some extra amount. So why are we doing this now? We have not completed the partner's capital account. We have to write this particular amount in the partner's capital. Only then we'll get that a different balancing figure. In this question, we will never get, we are not going to get the balance carried on as balancing figure. We have to first find the balance carried on first of A and B of all three partners, and then we have to find another balancing figure. That will be, the balancing figures will be either excess amount of cash or withdrawal of cash. So I will show you how it is coming. Okay, so I showed you how we calculated goodwill, right? Since in this question you have only given us the capital of the new, we have to do everything on the new profit sharing ratios basis, right? New partners capital proportion. We have to, what we have to do, that is in the question, new capital of the firm on the basis of new partners capital proportion. That is what we are going to do. We have already explained that. I already read out a particular passage, right? Here we have to find on the basis of new profit sharing ratio, old partners capital is to be ascertained. So that we are going to do. So in order to find old partners capital, that is on the basis of new profit sharing ratio, we have to find old partners capital. So in order to find old partners capital, first we have to find what is the capital of the firm. So in order to do the same calculation we did in the goodwill, let's see, in this question they have given us an adjustment that the capital, share of capital of C, which is 30,000, and we all know C's profit sharing ratio is 2 by 10. So in order to get the firm's capital, what we have to do, we have to just take this 2 by 10 into the equal to's into the other side, and what happens, 10 becomes multiplication and 2 becomes division. So 30,000 into 10 by 2 will get. So what will be the capital. We are assuming that this is the capital of the firm, which is 1,50,000. So now we have to divide this 1,50,000 new profit sharing ratio. The new profit sharing ratio is 5:3:2. So we have to just multiply 5 by 10, 3 by 10 and 2 by 10 on this 1,50,000. We'll get the new profit sharing ratio. New capitals of A, B and C on the proportion of new profit sharing ratio. So 75,000, 45,000, 30,000. Where we will write this? So that's what I'm going to show you now. Now let's write that balancing figure here. Usually this is the balancing figure we get, but in this question we found this amount in a separate calculation. That's what I was trying to explain. So 75,000 we got, 45,000 we got, and 30,000 we got. What did I did here? Okay, what did I actually did here? On the basis of new profit sharing ratio, we found all partners' capital. New profit sharing ratio is profit ratio. On the basis of new profit sharing ratio. So, in order to find the capital, all partners' capital account, we first find the firm's capital. So, for that we used the new partners' capital. We used the new partners' capital and his new profit sharing ratio, and we what did you do? We brought that new profit sharing ratio into the other side, and it became what? Multiplication become division and division become multiplication, right? So what happened? 1,50,000 into 10 by 2 is what came. Then what happened? 30,000 into 10 by 2 we did, and we got 1,50,000 as the firm's capital, and we are multiplying the new profit sharing ratio with it. So this is the what? This is this line. That is, we found the all partners' capital on the basis of new profit sharing ratio. This is all partners' capital. That is, every partner's capital we have to find. 30,000 we all know, that is 1,50,000 have to write. We also are finding partners' capital, 75,000, 45,000 and 30,000. Every partner's capital we found. Okay, so that's what we are going to write here. 75,000, 45,000 and 30,000, right? 30,000. Okay, so that's over. Now what we have to do? In this question, this passage, when you read further, we have to compare it, right? Existing capital have to be compared with the capital so ascertain on the basis of new profit sharing ratio, and excess if any. We have to see if it is excess, if the capital is excess or deficit. So now let's see. We have to first do what calculations? We have to add all this together, do the additions. Okay, now I will explain A's case. Okay, I'll explain A's case. So what are we going to do here? 25,000. Wait. It is here 75,000. I guess debit side will be more than credit side. So now let's just total up the debit side first. 8,000 plus 75,000. First I am just showing the calculation of A. Okay, we'll get to understand it by then. So 83,000 we got. So 83,000 is greater. 83,000 you are going to write the same here also. Okay. Now let's find the balancing figure. 25,000 plus 8,000 plus 16,000 plus 20,000 plus 10,000, right? 10,000. 79,000. So subtract 79,000 from 83,000. We got 4,000. Okay, balancing figure 4,000 have to be written here. 4,000. So what will we call this 4,000 as? That is the first question. We got balancing figure as 4,000 in case of A's capital. Okay, in the A's capital account we found 4,000, and that too in the credit side. So if this is appearing in the credit side of A's capital, what does that mean? Alright, we have to write by bank account. Now let's see which case. B's case. Okay, so in B's case, credit side will be greater. 65,000 plus 22,000 plus 2,000 plus 4,000 will get 71,000, right? 71,000 also will be written here. Then what we are going to do? We are going to subtract this 45,000 minus 10,000 minus 2,000. We'll get 14,000 here. 40,000 is appearing here. To bank. What does this mean? To bank balancing figure. That was 14,000. Okay, so we got how much? 4,000 as A's in the A's side, and B's side we get 40,000 as balancing figure. So what does this mean? That is what I am going to explain now. That is, how will the journal entry appear? In the journal entry it will appear as bank account debit to A's capital. So what is happening? We all know what is the entry when a partner or when a person brings capital to the firm. We all know that in the +1 and +2 we have already studied that basics. What was that? Cash account debit to capital account. That was the entry, right? That is, that particular person bought capital to the firm. Okay, so what is happening here is the entry will be what? 4,000 A have to bring again as capital. So same entry, we are just writing by bank account debit, that is bank account debit to A's capital account, because A bought capital 4,000, you have to bring 4,000 rupees again to the partnership firm. Okay, so that is what it means here. So debited, bank is debited means what? Partnership's bank is debited means bank is increased, that the amount which is there in the bank is increased. 4,000 rupees increase means you have bought 4,000 rupees to the partnership firm, so that it could make that the balancing the capital account can be can make it settle with the new profit sharing ratio basis. Okay, so you have to bring 4,000 rupees. What is in the case of B? B's what will be the journal entry first? Now let's read that. Journal entry will be B's capital account debit to bank account. That means partnership firm bank is credited. When will bank will be credited? Bank is an asset, so asset is credited means asset is decreased. That means the amount which is there in the bank is decreased. How much rupees is decreased? 40,000 rupees is decreased. How? It is actually debited to B's capital account. That means B have taken that 40,000. Since 40,000 was excess in case of B, the partnership firm told him that okay, you can take the 40,000 with you. So that is what happening here. So 40,000 is being taken away by B. So you have to write what? B's capital account debit to bank account. So that's what this 40,000 means. Hope this is clear to you. Okay. C won't be having anything because there is only 30,000. So 30,000 itself. Now let's prepare balance sheet. And the balance sheet, what we have to write? Furniture revalued value, that is 20,000 was the old amount of furniture, and in the revaluation you will get to see that furniture is valued at 30,000, and we have already did every calculations in the revaluation account. Now we can just show that 30,000, it is revalued at 30,000, we can show that 30,000 in the balance sheet. Okay, then comes stock is revalued at 39,500, we are writing the same amount here. In the debtors, we have to first show what? Since we have shown it in the revaluation account as provision for bad debts, we have to show it subtracting or lessing it from the debtors amount. That is assuming that debtors has been reduced due to provision for bad debts, you have to show it by lessing it from the old debtors amount. So old debtors amount is rupees 30,000 and it became 28,500. So we are assuming that it is because of provision for bad debts. So we have to less this 1,500 from this 30,000 and we have to show this 28,500 in the balance sheet. Okay, we have to show everything. Then comes what? Bills receivable. There is nothing said in regarding bills receivable, so we can write the same amount here. When it comes to cash at bank, what happens? We all know that 40,000 is already there in the old balance sheet. Okay, take that 40,000 plus what? 15,000. How did this 50,000 came? 30,000 plus 20,000. What is this 30,000, 20,000? Capital, C bought as 30,000. 20,000 he bought as goodwill, so add these two together, we'll get 50,000. So 40,000 plus 50,000 we got, minus 10,000. From where this 10,000 came? The A capital we have debited, that is we have shown that A have withdrawn. We have shown that the partners have withdrawn half of the reserve. So half of the reserve means 20,000 was reserve and half of it means 10,000 was withdrawn, and we have already shown it in the partners capital. So minus 10,000, fine. Then comes what? Plus 4,000. From where did this 4,000 came? So we have already discussed that 4,000 A have to bring, that is 4,000. A have shortage of 4,000, so we have to bring 4,000 to the partnership firm, and we have already told. So we have to do. Partnership firm is getting 4,000 from A's hand, so plus 4,000, and we have already said that B have excess of 40,000, so B can take away this 14,000. So B is taking away that 40,000, so we have to subtract this 40,000. Okay, so once we do that, we'll get the cash at bank as rupees 70,000. Hope it was clear. Asset side is okay. Now on the liability side, we have to first write this. First we have to write this 75,000, 45,000, 30,000 here as new balances. Then what we have to do? Don't forget to subtract 2,000 from this 25,000, because 2,000 the creditor said there is no need to pay. Okay, I will just forego that. He said that. So 25,000 minus 2,000, you have to write 23,000 here, and it is not said like anything. Nothing is being said about bills payable in the adjustments. We can write its exact same amount here, 5,000. So once we add both sides, we will get 1,78,000 as a total. Balance sheet will be tallied. Okay, now. Okay, I hope illustration number 7 was clear to you. Now let's read illustration number 19. After learning how to do illustration number 7, illustration number 19 will become easier for you. Let's read. There was 3 partners, compass, cone and circle, and they were sharing, the profit and losses were sharing among themselves in 3:2:1 ratio, fine. And they have given us 31st December 2012's balance sheet, and here in the adjustments they are telling that on 31st March 2013 cone is going to retire. Corn is going to retire. So there is only 3 months in this question also. In the previous question, which was of illustration number 18, I guess, in that question also there was only 3 months. We have to calculate. We were asked to calculate the goodwill and all and profit and all. But in this question, there is another thing that's coming. Fine. Now let's read further first. So here in this question, 31st December's balance sheet is given here, 2012. Plus 3 months, 31st March 2030 would come, right? So we have to first find the 3 months profit. Let's read. Now, cone is going to retire and compass and circle continued in partnership. Fine. Sharing profits and losses in the ratio of 3:2. So this is the new profit sharing ratio 3:2. All profit sharing ratio 3:2:1. So now let's just do the calculation and find the gaining ratio. In the previous question, which was illustration number 7, we did in our admission of a partner. What did I told you? They have given us the all profit sharing ratio and new profit sharing ratio. We found the sacrifice ratio. In case of admission of a partner, we have to find the sacrificing ratio, but in case of retiring of a partner, we have to find the gaining ratio. So gaining ratio is formalized new profit sharing ratio minus all profit sharing ratio. So let's do that first and come back again to read a further question. Okay, so this is how the gaining ratio is being calculated. See here. Let's see. Compass's new profit sharing ratio is 3/5 and all profit sharing ratio is 3/6. We subtracted this. Before subtracting, we have to first make the denominator same. After doing the calculations, we'll get 3/30 in case of compass, and in circle also we did the same. That is new profit sharing ratio minus all profit sharing ratio. First make the denominator same and then we'll get 7/13 as the answer. So we got positive answers. That means it is gain. But in this case, that is I have told you, if the answer is negative, in case we did new profit sharing ratio minus all profit sharing ratio and we are getting a negative answer, that means that particular partner is sacrificing. Okay, like in the previous question, illustration number 7, I have discussed it, right? Also applicable in here. So we got 3/30 and 7/30 as gaining ratio, so we have already calculated it. Now let's read the question further. It was agreed that adjustments were to be made in the balance sheet as on 31st March 2013 in respect of the following. So they have to prepare a balance sheet and some adjustments have to be made in that balance sheet. Let's read that. The machinery was to be revalued at rupees 45,000. That is, machinery was of rupees 42,000. It is now appreciated to 45,000. That is 3,000 is increased. We have to show that in the revaluation account. Stock is being reduced by 2,000. That is 15,000 was stock's amount. Apply 2% on it and we'll get 1,000. That 1,000 have to be shown in the revaluation account. The furniture was to be reduced to rupees 600. Furniture is of rupees 1,000. 1,000 is now becoming 600. That means 400 rupees difference is coming. So that 400 have to be shown in the revaluation account. The provision for doubtful debts would be rupees 4,000. See here, sundry debtors minus, that is less provision for doubtful debts. Provision for doubtful debts was rupees 3,000 and it became 4,000. That means the difference amount 1,000 have to be shown in the revaluation account. And here lastly, a provision of rupees 300 was to be made for outstanding expenses. As we all know, outstanding expenses is liability. So liability is increasing. That amount should also be shown in the revaluation account. That's it. Okay, further reading the question, we'll see. Partnership agreement provided that on the retirement of a partner, goodwill was to be valued at rupees 24,000 and Cone's share of the same was to be adjusted into the accounts of Compass and Circle. So what we have to do? We have to adjust Cone's share of capital, Cone's share of goodwill to the accounts of Compass and Circle. Adjusted into the accounts of Compass and Circle means we have to show it like Compass and Circle is actually bearing it. So Compass account debit, Circle's account debit to Cone's account, capital account. That is how journal entry would appear. So we have to do that. So goodwill of the firm is given 24,000 and Cone's share of it. So Cone's share, we all know that new profit sharing ratio is how much? New profit sharing ratio is, all profit sharing ratio. The profit sharing ratio when the retiring partner was there, was not gone. That is Cone is a retiring partner, right? So all these three had what? What was the old profit sharing ratio? All profit sharing ratio is 3:2:1. In that, Cone's share is 2/6, right? 2/6. So 2/6 of this 24,000. Why did I apply 2/6 on this 24,000? This 24,000 is the goodwill of the firm. Now we have to find the share of B. So in order to find the share of B, what we do? We used to multiply this 24,000 into or with what? B's share, which is 2/6. we'll get the biggest share of goodwill. That have to be, we'll get what, 24,000 into 2 by 6 we do. When we do that, we'll get 8,000. That 8,000 have to be debited to Compasses and Circles capital account. So how will it be debited? We have already found the gaining ratio, right? So gaining ratio, on in the base of gaining ratio, we have to debit this 8,000 to Compasses and Circles capital account and credit it to Cohn's account. That is what we have to do in this case. Fine. The profit up to the date of retirement was estimated at rupees 80,000. In the previous question, which is of illustration number 18, they have told us, they asked us to calculate the profit and all. But in this question, they have given us 80,000, which we are assuming that it is of maybe 3 months profit. So what we have to do? We have to share the profit, right? They have already given us a 3 months profit, that is 80,000. So how did I came into a conclusion that this 80,000 is the profit of these 3 months? Because they have, in the question they have given us a balance sheet of 2012 31st December, right? That means they might have prepared profit and loss account also. They might have got the profit, net profit. They might have shared it already with them. It was after the 3 months. These 3 months, that is January, February, March months profit, they might have not shared because they have not prepared the final accounts yet. So in this question, they have told that on 31st March 2013 they are preparing a balance sheet. So now this 80,000, this 3 months profit they are giving us directly in this question. There is no need to calculate it further. So that's what they have given us. Cohn was to be paid on full. Okay, so we have already learned a journal entry for this. That is, we will find the amount which the partnership firm have to give Cohn, right? So we will get that particular amount only after preparing the partner's capital account. After getting that amount, what we have to pass. There is a particular journal entry where we used to pass, which I already discussed during the theory section of retirement of a partner. See here, here the first entry. Payment at a time, subject to availability of the fund. Payment may be made at a time. At a time, that is lump sum amount is being paid. So retiring partner's capital account debit to bank account. This is the journal entry we have to pass. So pass that entry here in this case. Okay. Then reading further. Compass and Circle board to bring such an amount in cash so as to make their capital in proportion to the new profit sharing ratio. Again, this thing came. So why did I explain illustration number 7 is because of this sentence here. Okay, we have to do what? We have to make the Compasses and Circles capital balances on the proportion to the new profit sharing ratio. So for in order to make you guys understand the concept, explain illustration number 7 before explaining this illustration. Subject to the condition that a cash balance of rupees 20,000 was to be made as working capital. In this question, they have told us a condition that they have to keep rupees 20,000 as cash balance, so they can meet the working capital. So we have to do something in order to maintain this cash balance. We will discuss that in the solution part. Okay, now in the question they have asked us to pass some journal entries, necessary journal entries, and also you have to prepare a partner's capital account. These two things are only needed here. There is no balance sheet in this question. Okay, so the first journal entry will be passing what? Reserve is being shared among the partners. In this question, they have given us a reserve 1,20,000. 1,20,000 have to be passed with every partners. This is the retirement of partners case. Okay, so that this balance sheet came when 3 of them were there, right? So this everything, that the profit or loss or reserves have to be shared among all 3 partners. That's it. So that is the logic. So we are sharing that reserve with all 3 of them in their all profit sharing ratio, which is 3:2:1. Fine. Next entries of machineries, that is machinery is being appreciated by 3,000. So machinery asset is increased. So asset is being debited here. Machinery account debits to revaluation account 3,000 came here. And others are all decreasing. That is in case of asset. That is stock and furniture is decreasing. And 2 liabilities. Provision for bad debts and outstanding expenses are liabilities. So when liabilities increase, we have to credit. And when assets are decreased, we have to credit. So everything is being clubbed into one entry. That is what they have shown here. Revaluation account debit to stock account, to furniture account, to provision for bad debts account, to outstanding expense account. We have already discussed what all amounts have to be returned in the revaluation account while reading the question. Okay, then comes what? The revaluation profit. So it will be great if you have a revaluation account in your mind, so you get to, like, we can make sure profit or loss is coming. So it is profit that is coming in this revaluation account, so we have to share that profit with all the partners in their all profit sharing ratio. So 3:2:1, we are sharing the profit. Then comes what? And the question they have told us to adjust, right? Adjust Compasses and Circles accounts on the basis of Cohn's share. So I have already told you the journal entry you have to pass, and what will be the amount also. 24,000 into 2/6. 8,000 will get. That 8,000 have to be debited to Compasses and Circles capital accounts on the basis of their gaining ratio. Gaining ratio is 3:7, right? We have already calculated it, 3:7. So in the ratio of 3:7, this 8,000 have to be divided among the partners, and existing partners capital account have to be debited. It is how they are asked us to do. So okay, so we did what they asked us to do here. Okay, fine. Then comes what? Profit and loss suspense account. I've already told you when will this profit and loss suspense account appear? When an estimate profit is there. So they have given us in the question already estimated profit, that is 18,000. Okay. So you'll get confused in this particular section. There is no confusion needed. That is, in the illustration number 18, you will get to see we only credited the retiring partners capital account. But in this question, we are crediting all the partners capital account. So both these things are possible. That is, we can either credit only retiring partners account. That means this we have to show profit and loss suspense account debit 6,000 to Cohn's capital account 6,000. You can either show like this or in this way also. That is, profit and loss suspense account debit 18,000, which is the total profit we are sharing about with 3 of them. So either options you can choose. That is, in illustration number 18 we did this likewise. We can either write like this also, or we can either write like this also. Okay, whatever we do at final way, that is, our balance sheet will get balanced. Okay, so that's it. So we are just sharing. You can either show it like this also. That is, profit and loss suspense account debit 6,000 to Cohn's capital account 6,000. That is also correct, and this is also correct. You can do any of this. So that is this account. Then in order to pass these two accounts, first we have to prepare capital account. Okay, fine. Okay, so the first thing we are going to write is by balance brought down 40,000, 60,000, 20,000, which is there shown in our old balance sheet, that is provided us in the question. We wrote it. Then what we do? We then share the reserve, which we already passed the first journal entry. We shown it already in the first journal entry, and 50,000, 10,000, 5,000. Then we are sharing the valuation profit, which we have also shown in the journal entry, 150, 150. Then what happens? We are sharing the profit, that is 80,000 rupees with everyone. You can either do it like this, or you can also show as profit and loss suspense account and only credit Cohn's account. Okay, 6,000 will shown here. Okay, we can only write that 6,000 under Cohn's capital account on the credit side. We can either do that in illustration number 18, or you can do like this also. So 9,000, 6,000, 3,000. Then comes what? In the question they have told us that goodwill was to be valued rupees 24,000 and Cohn's share of the same was to be adjusted into the accounts of Compasses and Circle. We have already passed the journal entry, right? That is, we debited Compasses and Cohn's account. So we are going to debit Compasses and Cohn's account 2,400, sorry, Compasses and Circles account 2,400 and 5,600. We are debiting the Compasses and Circles account, capital account, and then we are crediting the Cohn's account. 2,400 and 5,600 together will get 8,000, which is 24,000 into 2 by 6. That amount 8,000 will get 2,400 plus 5,600. Do this and you will get 8,000. Fine. So till this you are okay now, I guess. Now for the further thing, in order to write the further things, what we have to do? We have to do some particular calculations. In this question they have told us to maintain 20,000 rupees as balance, and also Compasses and Circle have to bring some amount to make the capital in proportion to the new profit sharing ratio. So we know both Compasses and Circle have something to bring to the partnership account. So we don't know what is that particular amount. So in order to find what is the amount both of them have to bring, we are going to prepare bank account of the partnership firm. Bank account of the partnership firm. So for that, see the balance sheet here, and you will see the cash at bank, right? 40,000. Take this 40,000 as the opening balance of the bank account of the partnership firm. So by balance brought on 40,000. Then comes what? Then come back to the capital account. Compasses and Circle, we already know both Compasses and Circle have something to bring to the partnership firm. So we are keeping their accounts the way they are. Take Cohn's account. There is nothing to write in case of Cohn, right? So we can just total Cohn's account only. Once we total Cohn's account, we will see credit side is greater. So 84,100 we can write here. Same thing we can write in the debit side also. 84,100 will become the balancing figure of Cohn. So what did we understood from this? 84,100 we got as balancing figure under Cohn's. Cohn is the one is going to retire, and this 84,100 will be what? It will be the amount which the partnership firm has to give him. So why did they return here bank? We used to write loan account, right? This particular amount we used to transfer to loan account. But in this question, they have told us that Cohn was to be paid off in full. They are actually immediately paying him the amount. That is when does this loan account concept comes? When the partnership firm is paying him, but later only partnership firm is paying a retiring partner. So when such a situation arises, what we used to do? We used to transfer that amount to the loan account. But in this question, they are immediately paying off. So we can just write bank itself. Okay, there is no need to transfer this amount to loan account. We can write bank itself 84,100. So we know what Cohn is going to get 84,100 from cash from bank of the partnership firm. So we have to show in the credit side of the bank account, right? That is, bank account is being reduced because Cohn is going to get this amount, that is 84,100 Cohn is going to take. So what, bank account will be reduced to 84,100. We are crediting bank account 84,100. Understood, I guess. Then what happened? In this question, they have given us 3 months profit, that is 80,000. So we are considering that 80,000, like in cash case, what happens, since it is a profit, cash would be increased, right? So we are writing this 8,000 here, bank will be increased, amount in bank will be increased. So asset is being debited, bank account is being debited 80,000, fine. Then what happens? In this question, they have told us to maintain 20,000 rupees cash balance, 20,000 rupees cash balance to meet the working capital problems. Okay, so what we have to do, we have to write this cash balance at the closing balance. Balance carried on 20,000, we maintain to be maintained. We are writing it in the bracket to be maintained 20,000. Okay, then what happens? Total both this side, you will see credit side will be greater. 1,04,100 is the total. We are writing the same here. Balance figure will appear on the debit side of the bank account, that is 46,100. So if we are getting a balancing figure on the debit side of an asset, what is happening? That is, asset is being debited when the asset is increasing only. When asset increase only, we used to debit the asset account. So in this question, bank account is being debited by 46,100. What does that mean? There is something is bringing, that is 46,100 rupees coming to bank account of the partnership firm, right? Bank account is going to increase by 46,100. So what is the reason why this 46,100 is coming? There is only one possibility, because in the question they have told us that Compass and Circle have to bring some certain amount to the partnership firm. So we are assuming that this 46,100 will be the amount which Compass and Circle together will be bringing. But we don't know how much Compass is going to bring from in this 46,000. We don't know what is the portion of Compass in this 46,100. We don't know what is the portion of Circle in this 46,100. So we have to find. We cannot say that they will bring the amount in their new profit sharing ratio basis. We cannot say that. We cannot say that they are going to bring their gaining ratio. We cannot say that. Okay, so we have to find what is the amount Compass have bought, what is the amount Circle have bought. So we will get that amount as the balancing figure in the capital account. Okay. So in order to find that only, we are doing this whole calculations. Okay, so we got 46,100 now. Now we have to calculate. There are some calculations we have to do. We have to first find what? Closing balances. Closing balances we have to first find. So for that we are doing some calculations, particular calculations. Let's see that. So Compass is capital. We have to find the closing balance of Compass. So for that we are taking what? 40,000 plus 15,000 plus 150 plus 9,000. Then what? Minus 2,400. Okay, only till here only we have prepared. So take this amounts in the credit side we have only prepared till here. Okay, that till 5,600 only we have entered. Okay, so 40,000, 50,000, 150, 9,000, add this all together till here. Okay, then minus 2,400 and you will get what? 61,750 in case of Compass. In case of Circle, like this only. 20,000, 5,000, 550, 3,000, add these four amounts together, subtract 5,600 from this, you will get 22,450. Now, we have already learned 46,100 rupees is going to be bought into the partnership firm by both Compass and Circle, but we don't know how much Compass is going to contribute, how much Circle is going to contribute from this 46,100. So, just add this together. Everything adds together, we'll get 1,30,300. So, this will be the combined or together, let us say capital of both of them. Capital of both of them, combined adjusted capitals, we will say. So now we have to find Compass and Circle's capital from this. So usually what is the new profit sharing ratio? 3/5 and 2/5. So do that like this, do the same. 1,30,300 into 3/5, 1,30,300 into 2/5, you'll get the portions. So write these amounts here as balancing carried out, we got this amounts. Fine. So this will be the amount which we are going to write in the balance sheet, but since in this question they have not asked us to prepare a balance sheet, there is no need to show the balance sheet. Okay, so we are writing this here. Now add the debit side, because the debit side will be greater. 80,580 will get in case of Compass, write the same in here. And also in case of Circle we get 57,720 as a total, write the same in here. Now find the balancing figure. Balancing figure will be 16,430 and 29,670. What does this mean? I have told you already. When the amount is being appeared in the credit side, that is credit side of the capital account, that means the amount have to be brought, right? The partners have to bring amount to the partnership firm. So 60,430 is the amount which the Compass is going to contribute. Circle is going to bring 29,670 to the partnership firm. Add these two together and you will get this amount, 46,100. Okay. So we found what is the amount both composite and circle have to bring. Right? That's it. This question is over. We explained everything. So retirement of partner is also over. I think I'll be taking death of a partner in the next class. Okay, so thank you for watching Rocky Studies.